Good morning to another series with John Rothfield on what I learned this month. And for those who don't know John, John Rothfield brings decades of experience in financial institutions and public policy with a career spanning global banking, economic research, and investment strategy. His last position before joining Derivative Logic was as Chief Economist for CalPERS. I'm Rex Evans with Derivative Logic, one of the founding members. And so let's begin, John.
It's a pleasure, Rex, and you and I go way back in terms of
Oh,
our
yeah.
past careers. So it's a pleasure to be on today with you, asking the difficult questions.
And that I will. So last month, you talked about the U.S. drifting into a period of stagflation. Is that still your view?
Well, at that point, we had a situation where we had 2 quarters of 1%, around 1% on average growth, and we had some rising inflation. But I must say that since that time, we've actually moved back into a period of stronger growth. So momentum in the economy, strangely enough, despite the fact that we're in a war where we've had a mild energy shock, the economy is actually doing pretty well. And there was an interesting report out this week by the Boston Fed, which contrasted the impact of energy on the economy now versus the impact of energy in, say, the 70s and 80s oil shocks. And it basically showed that ultimately the US now has almost no net exposure to an energy shock because it's a net exporter of energy. And, you can talk about different sectors of the economy underperforming because people are paying more for their gasoline. But ultimately, the economy looks like it's breezed through here. We've actually had an acceleration of a few things. April retail sales caught my eye, the broad-based increase in April retail sales. Then we had the report on consumer spending in the month of April and showed that in real terms, after inflation, spending has increased the last few months on cars, furniture, appliances, telephones, smartphones, etc. And also pharmaceutical, drugs and household supplies. Residential construction is up in the month of April. So I would say that my fears about a stagflation episode, which is ambivalent for interest rates, has moved toward more like a potential or higher growth rate combined with inflation, which I think has been unambiguously upside for interest rates.
So basically, we're in a good economy.
We seem to be. Well, it's when you say good economy, I think it's a very unbalanced economy, and we can go into that. So if you look at the year to the first quarter of 26, so that's basically the first year since the Trump administration took over, the US economy has grown at 2.6%. All of that has been private final demand, so businesses plus consumers have grown. Now you compare that to the G10 peers, which is like the Euro area has only grown 0.25%, so has Japan. The UK has grown 1%. Canada's economy has actually been flat over the past year. So the US economy, once again, despite the various shocks that happened to the economy, has grown pretty quickly. The kicker, though, in terms of what's happened in the past year is that 2.5% is nearly all explained by productivity. So hours worked in the economy has been very flat. We've taken out certain kinds of workers like federal workers, immigrants, etc. So most of the increase in the economy has been productivity. And so really, even though technically AI is a wash for GDP because data centers are actually a very small part of GDP, and the business equipment investment that's going on as a result of AI has essentially been imported equipment, which is a subtraction from GDP. Even though that's technically the case, everything has really been about AI. So its impact on household wealth, to some degree, the adoption of AI, which has caused increases in productivity. Jamie Dimon was talking about that the other day. So I would say the counterfactual is always difficult and probably irrelevant because we are what we are right now. But I don't think that this administration's disruptive policies on tariffs, migration, and downsizing federal government would have been as so-called successful or smooth without the parallel rise of AI. The fact that both of these things are happening at the same time has resulted in a robust economy. I think another factor about the economy right now, apart from that kind of trend, growth 2.5%, has been crowding out. So when you have a successful sector like AI, you either get a rising tide floats all boats, was the income effect, or you get a substitution effect. And we've had a lot of substitution effects where the construction outside of business equipment and various AI related and the electricity grid that's required for those guys. Apart from that, we've seen weakness and so crowding out of other sectors. And it's really alarming, or it's very instructive to look at industrial production. Industrial production has risen very sharply for tech goods, but they're only 3% of the total. There's also been an increase in industrial production of infrastructure for tech, like those electricity grids, etc. But everything else has been basically flat for 2 years. Manufacturing output has been flat. Auto output domestically has been flat. And and then even production of consumer goods. So this onshoring story hasn't really worked because, again, the main game in town is AI. And then just finally to characterize the economy, I think the twin balances are important. One of the things that's capped the upside in interest rates has been the fact that we've had a modest improvement in the size and composition of the trade deficit this year. There's been a widening of the trade deficit in AI-related imports, but things like pharmaceuticals and consumer goods has been a significant reduction in the trade deficit. So, we've stabilized and even come down a little bit in trade deficit. And also the fiscal balance in the first 8 months of the fiscal year has been basically flat versus the year ago. So rather than those things worsening under these policies, they've actually been flat. So overall, I would say that, with a significant assist from AI, the economy's actually done very well despite these disruptive policies that have been introduced.
So you really, for me, you answered two questions I was going to ask, and that's what's the strongest part of the U.S. economy, and what is the weakest part of the U.S. economy today? And I think you brought up a little bit of the weakest part.
Yeah, so business equipment investment obviously has been the largest. Data centers have been large, but they're a very small part of GDP. The increment to the economy from the construction of data centers has been low, but business equipment investment has been very high. And as I said, the weakest parts of the economy are traditional construction. So in the year to the first quarter, manufacturing structures, the construction of those is down 19%. So this whole onshoring story hasn't really worked outside the tech sector. Offices, unfortunately, a lot of our clients are in that space, office construction outside of data centers. That's been down 12% in the year. Food and drink establishments down 6%, and single-family home construction is down 9%. So they've been the weakest segments of the economy. And then finally, it's very interesting to see the latest monthly report from the National Federation of Independent Businesses. Small businesses who were very optimistic when Trump first came in, their experience has started to turn over. They're finding it hard to get labor at the prices they need. They're facing some crowding out as well. So I'd say traditional construction and also small businesses are the two sectors that are being hurt by within the current economy.
This is a two-part question: what is the single biggest risk to the U.S. economy over the next 12 months, and what would cause you to change your economic outlook materially over the next 6 months?
Yeah, I think those two things are related. If you look at there are the 6 indicators that the National Bureau of Economic Research, who does the business cycle dating in retrospect, it says this is when a recession started. The one that's turned over quite a bit is personal income ex transfers after inflation. So it's basically, forget about transfer payments, but to individuals. But if you take personal income, raw personal income, and you take out inflation, that has tipped over to negative territory. So that is the one on the real side that's starting to cause some problems. Now, when you combine that with the fact from the New York Fed's quarterly survey of household debt, we are getting increases in delinquencies and things like that for various things like car loans and credit cards. And then I saw an interesting report a couple of days ago, Mike Johnson, the Speaker of the House. They're looking at doing something finally with Medicare and Social Security, which is, take off the cap, increase the rate from 6.2%, cut back benefits, etc. Now, that's not going to happen immediately, but if that starts to get into the public domain, we already have a very low savings rate out of current income. It's possible that both income and spending could start to decline at a greater rate later on this year. There's no particular moment that you would see a tipping point in that, but that is something that you could probably worry about on the recession risk side. Then the other thing I think to remember is that apart from the COVID recession, all of the recessions since the late 80s have basically been due to financial considerations. So I think they're the main things. A repricing of valuations in AI, which causes investors to sell other things as well, and that could turn into a rout. The risk in the private markets, which is very expensive, and even at CalPERS, there's been a new report suggesting that CalPERS is kind of overexposed to dodgy pricing in the private markets. And then, something else, something perhaps like 2023, which is there was a run on regional banks that, most, when you shock the system now, you do the stress tests, etc., the regional banks seem to be in better shape than they were there. But, you do get differences in banks' exposure to certain industries and certain regions. And that is a non-negligible risk of something like that. So I'd say the main risk of these repricing, where valuations are very expensive right now, plus the turnover in personal income.
This is something everybody, our clients want to get a better handle on, and it's looking at interest rates from the side of whether the Fed has a scope to lower rates later this year, or at the very least, the rate hike that is priced in being taken away. We got the new Fed chair is known to prefer trimmed mean inflation measures, which has actually drifted down to 2.3%. So, what are your thoughts?
Well, you have to take a side on this. Are we having a rerun of the 2022 experience where the Fed got behind the curve, or are we just in a temporary blowout in prices that's going to suddenly deflate?
Aren't they always behind the curve?
Well, not with Kevin Warsh, remember?
Okay.
Warsh has made this quote, I think, during his testimony, which is, we want a measure that captures the underlying rate and not the one-time changes in prices because of a geopolitical event or a change in beef. Don't know why he mentioned beef, but I guess meat prices have been up significantly. So he wants to look through, which is fine. And he's chosen something called the trimmed mean deflator for personal consumption expenditure. And just coincidentally, that measure has been amongst the lowest of the inflation indicators. So in the year to April, that showed a 2.33% increase year on year. That's not too far above the Fed's target of 2%. Now, that's a very technical measure because, for starters, there are 177 categories within consumer spending, and the trim mean takes out the top 31% and the bottom 24% of the weighted categories within the consumer index, and it comes up with a number. The reason it takes 31% off the top and 24% on the bottom is a technical matter that I don't want to talk about today. But there was an article in the Wall Street Journal that said that if you did the 8% symmetric trim, it'd be more like 3% through April. And so there is going to have to be a lot of consultation. Even Laurie Logan, who runs the Dallas Fed and is a centrist, and the Dallas Fed is the one that puts out that trim mean, said don't pay too much attention to it right now. So there's got to be a lot of discussion before we move to a trim mean. What do we take out? And what do we leave in? Do we take out the top and bottom 8%? Do we go to a wider number? Do we do a skew like we have in the past? And so there's a lot of work to be done before, the Fed basically is comfortable with that measure. Another couple of things I'd like to mention is because, you have to take a side on inflation, and I'm on the high side on inflation. So, one of the things about doing this the Wednesday after the employment report is it also happens to be CPI day. So the CPI came out today, and there are actually some downsides. Smartphones as usual, auto prices have been very flat, furniture, TVs, for example, health insurance minus 10%. That is a bogus number. We all know that our health insurance rates have risen, but in the CPI, they measure it according to the profits of health insurance companies. So when their profits are down, it implies that we're paying less, but that, as we know,
I have a hard time believing their profits are down, but anyway.
Well,
that's what
even
the
if they
are
down, they're not going to cut our rates. There's not much competition goes on in that industry. Particularly with a lot of those Obamacare exchanges kind of losing their competitive edge, etc. Then you look at where the CPI is rising a lot: software, airfares, delivery services, utilities, trash and water collection, parking, admissions to sporting events, apparel, veterinarian services, hospitals, and groceries. So you have all these factors that in the last 6 months are very high, and so I just want to mention a couple of others. Super core inflation. That's a number that is basically services ex shelter, and that's rising at a 6-month rate of 5.3%. The trim mean on the CPI side is rising at 3.2. Sticky prices are rising at 3.4. So all these numbers are 3 to 4% or even higher in the case of super core. And one final thing on that, there's an inflation nowcast by one of the Feds. The nowcast for PCE inflation, which is the one the Fed targets, is 5.25% for the second quarter, and the headline 3.25%. Again, 3 to 4% or higher on these inflation numbers. And so, you can say, well, let's hope that this is a bubble and we don't do anything about it. But it would be extremely irresponsible to continue with an easing bias at the Fed with these kind of 6-month inflation rates going on. The other thing you have to remember, and no one's talking about, is new 301 tariffs are coming, Section 301 tariffs, 10% or 12.5%. The government's lost a lot of tariff revenues trying to replenish that by moving from temporary emergency tariffs to permanent tariffs on a lot of countries. That's going to increase the tariff rate back to where it was after Liberation Day. You've got a super El Nino coming up, which in the past has caused significant crop damages, crop problems, and higher food prices to go along with higher fertilizer prices, which have already occurred. And then you have a labor market that's arguably either balanced or tightening. So you get suddenly this neutral wage story becomes a little bit higher. So, and then the final thing I would say in that producer price index, I have a chart in the package that I'll send around after this showing how widespread the producer price index increases have been in things like navigation equipment, electronics, etc. This is not just energy and transportation related price increases. It has been broad based.
And leading into with regards to the tighter labor market, and this is a question from a Bay Area client, so given the continuing tech layoffs, Meta 8,000 layoffs, for example, and a percentage of local, in particular, like Instagram teams, layered on top of tighter immigration policy affecting a region that draws so heavily on foreign-born talent.
So let's
that's a localized here in the Bay Area, but given that California is a major contributor to GDP in this country. I
It
mean, it's an
is. And
important
so
point.
let's step back a second and look for the national unemployment numbers. So we've had 3 months of private payrolls beating expectations quite comfortably and considerably, and it's broadened out beyond the healthcare and social assistance, which had been driving employment for the past year. So people are looking at these 3 months of higher payroll numbers in the private sector and saying, okay, these are green shoots which are taking off, and so the jobs mandate of the Fed now has to worry about maybe too much labor growth in a time where there's no growth in the supply of labor. I think it's a little bit more nuanced than that. If you look at that Kansas City Fed Labor Market Conditions Index, which takes 24 indicators in the labor market, that was actually only very slightly higher in April. And again, we're basically roughly balanced. A low higher, low fire. When you look across the completeness of labor market indicators. So we're neutral tightness, but neutral tightness is much better than where we were last year, where there was a lot of looseness in the labor market. So you do have to worry about the fact that the labor market is neutral to slightly tight. Now, when you look at the Bay Area, I took a look at this. There's the Bay Area and the Silicon Valley. Total jobs nationally in the past year have only risen by 0.2%. But if you take the San Francisco, Oakland, and Silicon Valley, employment has actually risen by 0.7%. Now that there's actually been tech jobs haven't been driving that, but Silicon Valley tech jobs have actually increased. It's tech jobs within the San Francisco area that have declined, but that's been more than offset by an increase in Silicon Valley tech jobs. So tech's been kind of neutral. But if you look beyond tech, the Bay Area, including Silicon Valley, has grown at a higher rate, 0.7 in the past year, as opposed to the national employment growth of 0.2. And there's two elements here. One, I think, is that California is a top 3 productivity state. So GDP in California typically rises by more than labor supply because we have a lot of high productivity industries. And of course, there's a spillover from the tech boom into other industries in retail, healthcare, and social assistance in the Bay Area have seen a lot of increases as well. You and I were both around in the Bay Area at the back end of the tech bubble of the late 90s, and it was hard to get in a restaurant. These tech guys were buying, wineries in Napa, etc. We're kind of in one of those modes right now, and I would say I wouldn't be too, there's still a lot of demand for software and other kind of developers. The labor market overall in the Bay Area plus Silicon Valley has been strong. So I wouldn't be too worried about what's going on in our backyard.
I'm going to maybe offend some soccer fans out there, but I think the most anticipated event is the new Fed chair, Kevin Warsh, a week from today, is going to start his new job, and that promised to be very interesting. And do you expect enough clarity from the meeting for the short end of the market to be able to reprice and perhaps take out that hike that's being priced into the market right now?
Yeah, I think sorry, go ahead.
No, and just, will there be a significant backing off from transparency?
Yeah, these are really interesting questions because when I think of the Fed, I think of a continuum from Volcker to Greenspan to Bernanke to Yellen to Powell, kind of a continuum, maybe skewed more left over time, but also a skew toward increased transparency. And transparency is interesting. It wasn't until 1993 that Greenspan decided to do minutes. They had a meeting in 1996 to talk about a 2% inflation target. Alan Greenspan said, do not let that out into the market. We don't want anyone to know that we're thinking about a 2% inflation target. Very secret, etc. But in the 2000s, we've moved to statements, a balance of risk assessment, a public, the minutes were speeded up, the release of the minutes. We started in 2007 with a statement of a summary of economic projections. We moved to more frequent press conferences. 2012, we had the longer run goal statement with a 2% in inflation. So we've certainly moved toward transparency, and it's an open question about whether that has actually helped the bond market. The transparency doesn't necessarily need to lead to useful guidance because the Fed is usually wrong. What is putting in there is some kind of representative idea of where its dots may be in 12, 24, and long run, et cetera, et cetera. So, are these useful because they've been wrong? And that's going to be a key question because it's likely that Kevin Walsh is going to get rid of some of this stuff. And there has been a critique. The word counts have become much longer. Powell has been criticized because he says one thing in the statement, and then there's a reversal after the statement. There's been an increase in dissents more recently. So it's going to be really interesting beyond the decision itself to hear the questions that are asked of Kevin Walsh, if he indeed has a press conference. We don't even know that. I'm not sure it's been scheduled. When people are going to ask him about, what's the output going to be from these meetings in the future, and then basically what that means for the the bond yield, essentially, because you have to be compensated for holding bonds, and uncertainty increases the required compensation for owning bonds. And then the other thing, of course, is, last meeting, they basically said, we're keeping rates, but we still have an easing bias. We're not going to be easing now, but we could be easing in the future. I think Walsh is going to have an escape clause here because he's going to be able to say, we're not going to be doing biases anymore. It's misleading. It doesn't help anybody. So they're basically, ultimately, I think, just going to say, we're not doing anything with rates right now. We're going to see what happens, without having a forward guidance, if you like. So that will actually help him. And I think overall, I look at Laurie Logan. Laurie Logan is basically a centrist on the Fed. She's like the Amy Coney Barrett of the Supreme Court. And she did a speech in El Paso a couple of days ago saying it would be irresponsible to basically saying, I'm increasingly concerned that higher interest rates could be necessary later in the year to restore price stability and appropriately balance both sides of the Fed's dual mandate. So she's the centrist. And I think you're going to get plenty of people saying, even if we don't have forward guidance in this, we're going to stand fast, and we're not going to rule out the possibility of rate hikes later on in the year.
A final question, because we're running out of time here. The 10-year bond, as everybody's probably taken note of, has risen from 4 to 4.5% since the war started. If there is a lasting peace, what do you feel the expectations for the 10-year Treasury? Are we going to have a retracement?
Yeah, it's interesting. So the 10-year bond yield has gone from 4 to 4.5%, as you mentioned, since basically the end of February, when the day before the weekend attack on Iran. And so we've added 50 basis points. It's useful to decompose that. So 40 basis points of that has been repricing of the Fed. We've gone from pricing in 1.5 cuts to 1.5 hikes over the next 12 months, basically, till next June. So, 100 basis points change is basically 40 basis points on the 10-year bond yield. The other 10 basis points has been so-called term premium, which is the residual. It's the difference between what an investor requires to be in a 10-year bond versus rolling over short-term treasury bills for 10 years. And that term premium has gone up another 10 basis points since the war started. So, there are two ways in which the bond yield could come back down. One is a repricing of the Fed to be less aggressive on tightening. And the other one is that increase in the term premium that's resulted from uncertainty shock, another one, related to the war, when it's going to end, whether it's going to lead to a sustained increase in inflation, whether that could come down. And, if I was looking at the next, 10 to 20 basis points, perhaps there is scope for some kind of downward repricing of the Fed. We'll have to wait to see what war says, because there won't be much forward guidance. So there could be. But I'm convinced in the second half of the year, as I mentioned before, taking sides on this. I think we're not in a situation like 2022 when the 10-year got up to 5%, but that is the direction of travel. So I'm still kind of the view that borrowing costs further out the curve are going to be higher in the second half of the year rather than lower.
Well, that's we've run out of time, but I want to add one commentary as far as with regards to what we've got now on the website. John Rothfield spent quite a bit of time on 16 economic explainers. And that was so dual mandates, one, inflation, kind of breaking down the numbers and how they're arrived at or what they mean. And I think they're very helpful for people to get a quick view or explainer of the numbers that are released and how to interpret them. So thank you, John, for that. That was a lot of work.
Yeah, and I've been very encouraged by the fact that your client base, when we do talk to clients either in person or on the phone, are very well informed about what's going on in the economy and have very strong views, etc., that are fact-based views. And so these are just more like an adjunct to what is the data, how has the Fed evolved over time, etc., that provide some additional background information on these economic data that ultimately go into the pricing to lenders and borrowers.
Thanks. And anybody has any questions, email us for the next What I Learned This Month, because a couple of these questions did come from clients. Again, thanks, John. Thanks, forward Rex. To next month.
Take care.
Thank you, you too. Thank you. Thanks everybody for joining.